Welcome to our viewers on EBNet Stream. I'm Leon Kraling, and I'm pleased to be joined by Marius Oberholzer, who is the head of the multi-asset team at Stanlib, one of South Africa's leading asset management firms. Marius, welcome, and thank you for joining us.
Thanks for having me, Leon.
I've been doing a bit of analysis of the various investment surveys in South Africa, and I noticed the particularly strong performance of the equity strategy, the institutional equity strategy that's called the Enhanced Multi-Style Equity Fund that's offered by Stanlib. And then looking at that, I'm going to actually be interviewing your equity team as well. I then glanced my eye at the balanced funds, or what I call balanced funds, what you call the Stanlib Multi-Asset Growth Fund. And I noticed over similar longer term periods, that fund is not doing as well and ranking as well as what perhaps the equity fund is doing. And I wanted to spend some time with you just to understand the dynamics behind that, to help our viewers actually understand that when they compare performance of different asset managers, different strategies and so on, what the influences are in the rankings and the performance. I also noticed that your shorter term performance on the multi-asset growth fund is looking good. And I wanted to understand the context thereof and what's leading towards that, and to glance a little bit forward about what might come given the strategies that you have within the fund. So perhaps let's start off. Let me just create the context. 42 out of 48 over a 3-year period for the multi-asset growth fund, 35 out of 45 over 5 years. However, 15th over 1 year. Very interesting picture that, where the equity fund is ranking in the top quartile over the longer period. So perhaps if you can just comment on that and why there has been or is that discrepancy.
So Leon, you've got a lot of questions there, and I need to unpack them briefly. The first thing is Rademacher for Mark and his team have done a great job in terms of systematic solutions. I think it's a brave call that we've made as a business to go down that route. But when you have a racehorse, you let that racehorse run. And Rod's has been with the business now for just over 5 years. And there was a meeting of minds, certainly between some of the investment heads and Rademacher's approach to harvesting excess returns for clients. So we're very pleased with what he's been able to generate. I think contextually, I must just also maybe point out some of the incorrectness to your analysis in terms of the multi-asset growth fund. That fund has only been running since October 2022. We initially set that portfolio up in the business that I was managing at the time, which we called multi-strategy, and it was an evolution, if you like, from the previous absolute return business that I'd been spearheading since 2015, and previously jointly with Eben Marais when I joined Stanlib in 2013. But the multi-asset growth fund was initially set up as a targeted return fund, targeting CPI plus 5. And soon after we launched it, the decision was made, I think knowing what was coming, which I'll get to in a second, around some of our very senior and well-regarded portfolio managers and business heads getting towards retirement age. And the thought process then was that we'd move the multi-asset portfolios, or balanced portfolios as you call them, away from our balanced and equity team, spearheaded by Herman van Velze and Henk Viljoen, both very well known and well regarded elder statesmen, into our business when they reached retirement age. And that took place in April of 2023. So ultimately these portfolios, whether it's multi-asset growth that started in October of 22, or our multi-asset cautious portfolio, which transitioned across to our business on the 1st of April as well. So that's the timeline. The generator of returns, as you call it in the short run, maybe the last 12 months, I think has been consistent since those portfolios came across to us. On the 1st of April 2023. And it's consistently outperformed. Initially, we were pretty much market performers into the back end of 2023. The markets were pretty poor at the time. You'll remember people were worried about credit blow-ups, equities were not performing, interest rates were going up, etc., etc. And we pivoted hard to our macro process, and we're a top-down group. We don't evaluate stocks on a bottom-up basis. And while Rademacher would be considered bottom-up, he's approaching it from a systematic perspective and a multi-factor perspective.
So if I can just come in then on that. So you say that the fund, the multi-asset growth strategy started, you said 2022.
October 22 was the launch date.
So in that context, the back history that it's carrying within the surveys, goes back 7 years, if not longer, in terms of the results. What is that historical record that it's showing then?
It shouldn't be showing anything longer than the just shy of 2 years now. In fact, when we look at the Morningstar data, I don't believe that it doesn't go further than the inception date. But what I believe maybe the institutional surveys might be doing would be splicing together the old balanced fund and our record. But again, I speak under correction. But really, it's like comparing Germiston with Somerset West. It's not appropriate for clients to look much further than when we took over those portfolios.
What are you saying about Germiston?
Or Somerset West.
Whichever one. So, okay, that's interesting. And I'll actually look into that to see what the history is. And it shows you the importance of the context ultimately in looking at these surveys, because the survey does reflect that history, and that history is not really representing an accurate picture of that fund at this current point in time. So let's maybe focus a little bit on that, if you don't mind. So can you spend time, and you mentioned top-down approach, but can you first of all comment, is the equity exposure within the multi-asset growth fund similar or equal to what's in your equity funds, first of all? But what else differs in that regard in terms of approach to management, and what is the approach that you're following on that fund, and how does that compare perhaps to the rest of the market?
Yeah. So the first thing is to say yes, Rademacher's strategy is absolutely reflected in our multi-asset portfolios across the board. We run a large book, about 142 billion under management across a wide variety of segregated as well as unitized vehicles, if you like. So he is in our suite of strategies. The difference would be is around the sizing of his strategies. Our view around how to manage multi-asset portfolios or portfolios in general is we are not looking for massively volatile returns, and Rademacher being a pure equity strategy and the concentrated bets that he runs, sometimes his volatility or tracking error would be slightly higher than we would like. Additionally, any alpha stream comes with periods of great times and periods with not so great times. And again, because we like a smoother return profile, we blend Rademacher's systematic strategy with a number of other strategies, including passive equity on occasion and sector bets on occasion. So he's in the portfolio. We look at things from a top down, and as I mentioned, he looks at things from a slightly differentiated bottom up perspective. I would suggest where there's a big difference between his equity portfolio and ours is when he includes offshore. There's a different vehicle that he uses, and we use our strategic partner for a large chunk of our offshore exposure, and that comes through a multi-asset solution offshore rather than a pure equity solution. So again, much more concentrated in the equity space, and again, the way we arrive at our asset allocation decisions versus the way he arrives at his sector picks and his stock picks is very different. Hopefully that answers the question.
So just for the benefit of the viewers, two questions. I'm assuming it's not possible that he may, as an example, be overweight Naspers, yet you would be underweight. That should not happen.
It wouldn't happen in the sense of us trying to mitigate his specific bottom-up bet. Where we would take a differentiated view versus Rademacher and the alpha streams that he's generating would be if we think the risk is too high. In other words, where we've got Naspers and we may have Chinese tech stocks as well as S&P 500 Mag 7 stocks, we would say the exposure to a single alpha stream, be it technology, be it growth, be it quality, however you want to define those things, is too big in our portfolios, and we want to diversify away from that. And so we may hedge a little bit of that exposure out, but it wouldn't be at a NASPAS level. It would be around the factor, the stylized basis, or the country concentration, for instance.
Okay, good. And then the second question is, you mentioned your offshore partner for the global side of it in their balance fund. So who is that offshore partner, and what does that fund sort of represent?
So the offshore partner, and it's a strategic partnership that Stanlib announced a few years ago, and we're very lucky and very proud of the partnership that we've developed with JP Morgan Asset Management, one of the biggest asset managers in the world. And as it relates to my team specifically, we've been working with them since 2019. So we were the guinea pigs, if you like, for Stanlib. And we work directly with the multi-asset solutions team based out of London, although they have offices and team representation across the world. It's very different from I suspect, from the partnerships of old, and certainly the partnerships that Stanlib's historically had with Columbia Threadneedle and Brandywine, to name two. And we wanted an investment partnership. And that investment partnership, ultimately, the way I would explain it most clearly, and the spirit of which we've gone into that partnership, certainly with the team that I do most of the work with, is an extension of our portfolio management team. That team sits in meetings with my team fairly regularly. They contribute to our tactical asset allocation, and they understand what we're doing with the portfolio. And for instance, where we are hedging out their alpha streams because they are taking bets that don't align with our total portfolio view, because we manage this as a one holistic portfolio, we'll hedge that out, and we'll be very clear with them around why we're doing it. But importantly, they'll argue with us about their views and our views and what we're doing. And as I said, just as in the same way we've deliberately built out a team in the multi-asset space in our business, we welcome the insights that they give us in the same way I'd welcome the insights from my team in terms of what they're contributing.
So quite interesting in that regard is, how do they view the cancellation or postponement of the budget at last minute, as well as threats of tariffs and sanctions, compared to how we view it? So have you picked up a difference in opinions on that?
No, I mean, I haven't chatted to them this morning, but I would say that while they look at South Africa, they clearly don't deploy capital into South Africa as it relates to our strategy. That's very much our domain, although we will ask them to opine on fixed income and equities from an international perspective. But I have not had the chance to talk about that. I can obviously provide you with a view that my team and I have, but I think that's probably outside the scope of discussion, unless you want me to go there.
So I'll let you off on that one, and give you a little bit more time, maybe for another day. Just maybe let's talk about, you mentioned tactical asset allocation. So what are the bands within which you manage that tactical asset allocation, and is it around a fixed point that you manage that?
Yeah. So, Leon, I come from a hedge fund background. I didn't spend time in the long only world before I went to a hedge fund. I grew up in a hedge fund, and in a global fund, initially based out of London, then later out of Hong Kong before coming back to South Africa. So my background is if you'd like, unconstrained in the thought process and the way that I would bring a portfolio together. And I've surrounded myself with guys that think a little bit more constrained, because clearly in our world, you sometimes need to protect yourself against yourself, right? But that thought process then around how we might pivot around a central North Star is one that we certainly make based on where we think the peer groups are. Because, for instance, in our cautious fund, I alluded to the fact that initially it was a targeted return fund. In a targeted return fund, we would have a North Star of trying to generate a CPI plus 5, for instance. In this portfolio, the growth fund that's evolved into competing with other balanced funds and trying to offer a return profile that is similar, although with lower volatility, means that we clearly need to be aware of the peer group, where the peer groups are. And the next component is that our clients, we don't believe, are investing in a flexible fund. They're investing in a high equity multi-asset fund, which means that my range for equity should be around 60 to 75% at any point in time, because of the ASISA classifications. In our absolute return strategies, we've had zero equity multiple times. In the last sort of 10 years that I've been managing the absolute return solutions within Stanlib. So the thought process is unconstrained, but the bands are a little bit narrowed based on the client requirements. So in our cautious fund, we would be sitting with anything between 10 and 40% equity at a total portfolio level versus, just SA. So we're not we don't have a flexible solution. Watch the space. It is very much our playbook, but we would anchor around a North Star. And because we're sitting with peers, we can guess roughly where the industry's strategic is. We do a lot of work on strategic asset allocation and what we need to be targeting and generating mix of assets to deliver on a return profile that would look similar to peers in our segregated world. And there's a bit more flexibility. But here we are flexing around what we think the peer group is anchored on. Ultimately, it's a CPI plus 5 or 6 target. That's what the historic return profile has looked like in the high equity multi-asset. But we're going to use lots of different levers to get there.
So in that category of the multi-asset balanced sort of 60 to 75% equity world represented by, say, Forbes's Global Manager Watch, that's around about 800 billion in assets that are surveyed through that. Your fund sits at about 9 billion, which in the context of Stanlib is actually quite small. So I'm assuming there's more. There's a lot of other multi-asset funds and so on that you are managing as well.
Yeah, that's correct. We have a third-party book of business in the multi-asset space that's probably close to 20 billion. A little bit more than that, maybe 25. We've got an absolute return business that's north of 20, and those are both pooled vehicles and segregated vehicles. And we've got 2 large multi-strategy range of portfolios that we manage that's close to 70 bill. So that kind of gets us pretty close to the 140 with some smaller bespoke things that we do around the edges.
So when your team was then brought together in 2023, it was communicated to the market that it was a team of 10. So has that changed now? Has that evolved from that point?
No, I think the team hasn't changed since the time that we took over these portfolios. The team has been growing, obviously, over time. As we've I think delivered on the promise and the success and raised more assets and been asked to do more varied things, I've had to hire more people, one, but importantly, I've wanted to hire different kinds of people, and a background that lends itself to something we don't have in the team. So in the industry, everyone talks about cognitive diversity, but we all go and hire CAs, or CFAs. I don't get it. And again, given my background in a hedge fund, you can get ideas from all sorts of places. I'm not wedded on quantitative investing or qualitative investing. My background was qualitative macro, or discretionary macro and equity long short. But I come from a hedge fund background, which means my time horizon's quite short relative to large pooled institutional portfolios taking a 5 to 10 year view. And I needed to get people around me that could complement the skill sets and bring different skills to the team. So we hired data scientists, we hired quantitative skills. I've got ex-strategists, I've got ex-proprietary traders in fixed income and foreign exchange, where I felt that we needed to beef up our capabilities. And of course, importantly, because we have one single multi-asset team at Stanlib now, there's much less internal competition, which was one of the issues I think we had historically, where I can lean very aggressively on people like Radame and his team around giving us quantitative signals around factors or in equity markets, both locally and offshore. I can lean on the JP Morgan guys quite aggressively. I can lean on Victor and Sylvester in the fixed income team, and Johan Marnovic in the credit alternatives business, unlisted credit, Greg Babaya in our private equity and infrastructure business, Nessie Chetty in our property business, not just around managing managing capital for us at a specific strategy level or developing a new strategy with them, but really gaining those insights that's going to scratch at my team's view. But importantly, if my team and I are accountable, we have to have the portfolio pointing in the direction we want it. So while we may have many different inputs at a bottom-up level, the macro view, the top-down view is ours. And then the next stage, again, and again, excuse me mentioning the hedge fund world, but risk comes first. So we would say that we have an edge in managing portfolios only because we manage risk so aggressively, and we think about how can we structure an investment position that we take with the least amount of risk if things go wrong and it doesn't play out. So there's quite a bit of derivative usage. So even though we might want to own equity, which equity do we want to own? Can we express it in a low risk manner? And at times, for instance, we're going to hold something like Radome in the equity business portfolio in that specific asset class or strategy, but we're going to want to hedge out the beta component. And we're very happy to do that at points in time, or the geographic component.
Okay, well, look, it sounds, I mean, everything that you explained, the team, the approach and so on, and if you look to the performance, it looks like it's bearing fruit, which is great to ultimately see. And I wish you all the best in the continued success in that respect. But I think what today's conversation should hopefully teach our viewers is that context is all important. Simply looking at the surveys, taking the numbers as they are at face value without an understanding of the background, the dynamics that go into all of this can be faulty. So it's important to get that context through conversation and through questioning at the end of the day, and hopefully they can take a little bit from this in that regard.
Yeah, hopefully I've given that. And I think, we bracket all these multi-asset funds or equity funds together, but the way that people get to the return profile is really what matters, and investors understanding that. So it's exactly your point. How has a portfolio manager got there, and can a blend of different portfolios give you different alpha streams or non-correlated returns? And that's ultimately around what we're trying to build from the way we structure a portfolio, and guys like you advising on for clients to build more larger pooled portfolios.
Yeah, totally agree. Marius, I won't take up any more of your time. Thank you so much for spending time with us today. We wish you all the best going forward. That's Marius Oberholzer, head of the multi-asset team at Stanlib, and this is Leon Kraling of EBNet Street.